is willing to take, but that's kind of where I'm at. So that means with the high at 10.08, I am going to be into this market if I can get in at 10.18. So I'm going to set my targets. I'm going to, do my 10.38 is going to be my first target because I want to take my 10 cents and find it somewhere right in there. 10.58. Again, I believe I hit that one right in here somewhere, 10.58. So the first two contracts did produce some money, some profits, some nice profits. But then there always comes that time when the situation starts to change. And you notice the turnover, the crossover of the predicted differences. You have the turn down in the neural index where things start to look a little weak. And so you have to be prepared for that turn in the market, which occurred right here. And so you're going to have a stop below that predicted low. The predicted low was, it's where you were stopped out at 1042 minus 10. 1042 was your predicted low, minus 10, so you'd be stopped out at 1032. So even though you didn't make as much money on this trade, still not too bad because any trade that comes up with the profit always is a good trade. Then after you watch the market, now you're out of the market, you're sitting there a little bit sideways, you're kind of wondering what's the next step going to be. You may not have waited here, you may have jumped in, a little bit, trying to jump in, anticipate what the market is going to do, but you come into a point right here where you have the market making a predicted low on January 12th of 9.94, so you minus your 10 cents from there, and you're going to be into the market at 9.84. I said 9.94 was a predicted low, but 9.84 is where you're going to be short the market. One of the nice features about this is that when you're looking at charts, you never want to overlook the potential moves that other people are looking at. And a lot of traders, when they look at the traditional technical analysis, they're going to be looking at this low that I mentioned before, which is a breakout of that low is indicated as a spot where they might go short. So you have to be aware of what other people might be thinking. When that coincides with the low that we have projected here by the penetration of the predicted low, pretty good sign that you could have a market that could go lower, which is, of course, what has happened here. The most recent situation, of course, is that the market has tended to turn a little bit. We have a situation where the predicted differences are moving up, not hugely, but they're moving up. The predicted neural index is at 1, which is a bullish situation. So the odds are pretty good. If you were trading this particular market, you would have gotten stopped out somewhere right in here above that predicted high on this candle right here, because once you set that predicted high at the lowest predicted high, you don't want to be moving your stop up and down, back and forth, but you want to maintain it right there and get out, take what you can get for the profits and not take a chance of playing with the market. Now the next possible trade that you would have had here in the situation you would probably be in today is that if you were looking at the situation with the predicted high here, you would have probably gone long, could have gone long on this situation right here at 10 cents above the market, and you would now be long, even though it seems maybe a little bit, not the type of thing intuitively you might do, but you might be long soybeans right here. You possibly, depending, I didn't measure this out, it might have been enough to knock you out of the market with a small loss, but the position now, if you're in soybeans, would probably be on the long side unless the market tells you something different. You don't try to anticipate, you don't try to guess what the market is going to tell you, but you kind of let the market come to you and tell you what it wants to do, because there's no way you are going to tell a market what it ought to be doing. Just to look back a little bit, review some of the situations that we have with the breakout type of trading. Mentioned before, when you look at breakouts and consider the breakout situations, you have to remember that breakouts can be very subjective. Where's that trend line? Where's the high? Where's the low? All of those kind of things are kind of things where you have to sit and look and observe and so forth, so that can lead to some fairly subjective types of decisions, and not every trader is going to make the same decision. That's part of what makes markets. As I mentioned, when I use the vantage point indicators, the predicted highs and lows to set up a channel that I use, which is different than the pivot points or a lot of other channels that other people might use. But I'd like to have some kind of support, some kind of a confirmation from other indicators, and the predicted moving averages, the predicted differences, all of those kind of things. They provide the alerts that you might have a potential breakout shaping up. Again, you don't anticipate, but you kind of be prepared for them when they do happen. Also, I mentioned the multiple contract positions. That way, if you have a possible type of situation where the market is moving, and if you want to stay with it, you can stay with it. If you have only one contract, it's either kind of an all or nothing. So that's why if you have a choice, I guess my size account would prefer to trade the mini contracts and trade several of them as opposed to one large size contract, because that would give me more flexibility of where to get in and where to get out of a trade. Now, a couple of other things here just to get some feedback from you. I use gold as an example market today for the most part, showing you kind of the breakout type of strategy. And the original question that I wanted to ask, to have everybody talk about, is what would be your opinion as to whether the market would be a breakout to the upside or the downside? And today's action kind of determined that. It broke out to the upside already, so I guess by preparing it on a day after a holiday, sometimes those kinds of things happen. So that kind of makes it a moot point because it did break out to the upside. So now the question is, I want you to look at that little man again, and if you agree, you can say, I agree. But the question here is, or the statement is, I believe the upside breakout will reach the January 11th high of 1163. If you agree that the gold market is going to move on up, reach the January high of 1163, click on I agree. If you think gold is doomed and is headed lower, some people talk about gold and commodities and everything going lower because of the pressure that we'll get from the U.S. dollar. You're not going to agree, but do you agree is the breakout will reach the January 11th high? Okay, I see we're seeing some disagreement. So some people don't think that the gold market rally that is coming out of here has legs. Some people do, which I guess we don't really have a consensus here, but a little bit of an edge that the gold market will not reach the 1163 January 11th high. That's what makes markets. Everybody has an opinion, and everybody expresses their opinion in the way that they trade. Now you'll see the information, the contact information on the screen. If you're interested